What if the biggest shift is not the one everyone is shouting about, but the one governments are finally speaking about out loud? For years, certain currencies lived only in rumor and speculation. Today, one of them has quietly crossed a line that changes everything. For decades, currency watchers focused on the usual names: the Iraqi dinar, Zimbabwe, long-waiting stories built on patience and belief. But while attention stayed there, something else was happening in Southeast Asia, steadily, quietly, and with far more discipline. Vietnam did not chase headlines. It built factories, trade routes, and supply chains. It became essential to global manufacturing. And yet its currency stayed stuck in a structure designed for a much older economy. That disconnect is no longer being ignored. As January 2026 began, something subtle but important changed. Topics that once lived only in forums and private discussions began appearing in official state messaging. Not hype, not promises. When the Vietnam News Agency speaks, it does not speculate, it reflects policy direction. That alone forced analysts to pay attention, because governments do not discuss currency structure unless internal conversations are already underway. Timing matters here. Vietnam is pushing for aggressive economic growth targets this year. Double-digit expansion is not possible without foreign capital, financial transparency, and global trust. A misaligned currency becomes friction at that scale. Investors notice, trade partners notice, negotiations become harder when numbers no longer reflect reality. Inside recent official statements, language around alignment and fundamentals stood out. Not dramatic, not emotional, but precise. The kind of language ministries use when preparing markets, not surprising them. This is not how governments speak when nothing is happening. To understand why this matters, you have to look backward. After major reforms decades ago, Vietnam kept its currency weak on purpose. Cheap exports fueled growth, jobs multiplied, factories expanded. That strategy worked, but success changes the rules. As the economy matures, a suppressed currency starts working against progress. It raises import costs, complicates investment, and quietly taxes citizens through reduced purchasing power. What once helped growth now limits it. That is the pivot point Vietnam appears to be approaching. Regional financial centers are already watching closely, not reacting publicly, but adjusting quietly. Forward contracts, exposure levels, and liquidity positioning tell a story long before headlines do. Institutions do not move money based on emotion, they move when signals align. This is where the comparison to other currencies becomes useful. Iraq, Zimbabwe, each faces different challenges, different timelines, different constraints, but Vietnam offers a real-world example of how reform actually unfolds. It is never sudden, never loud, it is staged, technical, and deliberate. At the center of this is the State Bank of Vietnam, balancing growth with inflation control. Infrastructure spending needs credit, imports need stability. A currency allowed to reflect real value can ease pressure instead of adding to it. This is not about shock moves, it is about control. Long-term holders understand this. When governments speak carefully, progress tends to follow slowly, not explosively. Trading bands widen, controls loosen. Markets are allowed more room to breathe. That protects the economy while still moving forward. Technology is adding pressure too. Vietnam is deeply integrated into digital payments and cross-border settlement systems. Those systems demand accuracy. Artificial pricing becomes harder to defend when transactions happen in real time. Transparency stops being optional. International institutions play a role here as well. Frameworks from global financial bodies are not orders, but roadmaps. Vietnam's messaging increasingly aligns with those standards, signaling confidence rather than dependence. For observers, the real lesson is not prediction, it is pattern recognition. When official language changes, it usually comes after internal consensus. When preparation becomes visible, execution often follows, slowly and methodically. Energy costs, middle-class growth, and consumer purchasing power all feed into this decision. A stronger currency lowers import costs, supports living standards, and signals maturity to the world. That matters domestically as much as it does internationally. For those watching the Iraqi dinar and similar currencies, Vietnam reinforces one truth. Currency reform is not a lottery ticket. It is the final chapter of years of groundwork. Skeptics point to past delays. That skepticism is healthy. But what makes this moment different is not excitement, it is clarity. Words like imbalance and correction are used lightly by governments. They signal acknowledgement that the current structure cannot last forever. As global power shifts and emerging economies demand fair representation, currency value becomes part of sovereignty. Vietnam is positioning itself accordingly. None of this guarantees timing. None of it promises instant outcomes. But it does move the conversation from fantasy to policy. That shift alone is worth paying attention to. The next phase will not be loud. It will be technical, software updates, contract adjustments, regulatory fine-tuning. The unglamorous work that precedes real change. And that is exactly where real transformations begin. We will continue tracking verified developments as they unfold, separating noise from substance, because in currency reform, patience informed by facts always outperforms excitement fueled by guesses. Stay focused, stay grounded. The story is far from over.